Well, the government shutdown is well underway and the markets are reacting to it. So the question is, how does this affect your hard-earned retirement savings? Stay tuned to this week's episode of the Retirement Income Source, where it's all about your income.
Welcome to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels, here with our host, David Scranton, and today we're talking about the government shutdown. And Dave, I just wanted to ask you, were you personally impacted this weekend when you were flying back into Florida? I know there's been some of air traffic control issues, finding enough people to staff the airports. Did you face any of those issues?
You know, I wasn't. I had to fly Sunday to a business meeting in the Carolinas and then Monday here. And and for our new listeners who don't know, I'm actually a pilot myself. I'm an airline transport rated pilot, and I fly my own airplane sometimes coming back and forth. And, you know, in general aviation, I would be the first one that would be knocked off a flight plan if they were short air traffic controllers. They would say, you know, forget it. We need to get all the commercial guys up in the air. We're not giving you, you know, a clearance. And that didn't happen. I didn't get any delays or anything. So maybe I was lucky. Maybe I just didn't get to hit the airports that are being more affected or the regions, but down the East Coast was pretty good, and that's busy airspace.
Yep. Well, that's good news for you, and maybe, like you said, maybe it's affecting more of those the West Coast or more the middle of the country versus the East Coast. But the government shutdown is dragging on, and it is continuing to affect the markets. And I know that most people are wondering, you know, how could this affect my retirement if it continues to drag on?
So I'm going to be really reluctant, but I'm going to share with you what happened last time there was a government shutdown, which was from December of 18 through January of 2019. It was 35 days long. And the reason I'm reluctant is because the markets actually reacted positively during that time. It's a little different from what we're seeing now. During that time, the S&P 500 actually went up close to 10% in the time when we had the last shutdown. So the reason I'm reluctant to say this is because I don't want you to go get more aggressive jumping in the market with everything thinking it's going to go up because there's a shutdown. We were in a different economic situation back then. Interest rates. Interest rates stayed about the same. You know, we always talk in the show about the 10-year government bond, which kind of is tied to most other bond rates, yields. And the 10-year government bond started for day one at 2.75%, of course, a lot lower than it is today. It's over 4% today, and it ended at 2.75%. Now, in the middle, it dropped by almost 0.25%, and of course, the reason is because there was a little scare at one point in the middle that we wouldn't get our act together and approve a budget. So, essentially, money flew into government bonds as a flight to quality, as they like to call it, and drove the yields down, but then they came right back toward the end. So that's what happened last time. But this is different, Sarah. This is different because what we're seeing is more of more volatility, a little bit of a more frightening situation in the market. It's not terrible, but I think a lot of that too has to do with other factors, such as some of the trade wars, the tariffs. I mean, just the fact that 100% tariff threatened on China, right? What does that do to trade? Does that disrupt the markets even more? That's a real concern. And at the same time, we have other things going on right now in the markets. The other difference now is we have a technology market that's been going nuts for 2.5 years, and nuts in a good way. So you hear all the pundits talking about, okay, we had the tech bubble burst at the beginning of the year 2000. So is this 1999 where it's about to happen again? Or is it more like 1997 and 1998, right? And it's so easy when you look back to history books that, well, 97, 98, we had more ability for this bubble to expand, and it's so easy in hindsight, right? But right now, you're in it, you're looking, trying to say, well, are we in 97, are we in 98, are we in 99, it's about the burst. So I think between the fears of that and the concerns about the trade war, and then you just throw on top of this, not being able to approve the budget, and that's why you see all this volatility this time.
It's a little bit of a different situation than what we saw at the last government shutdown at the end of 2018. And that's partly why we put together a one-page flyer for our listeners of the retirement income source. It's what the government shutdown can mean for your retirement. It's a quick summary of what services may be affected or delayed versus what's not going to be affected during a shutdown. And I want to encourage everyone to reach out to our website. You can go to incomeradio.com and get that free guide just for our retirement income source listeners. And thank you for listening to the Retirement Income Source, where it is all about your income. I'm Sarah Samuels here with David Scranton. We're talking about the government shutdown dragging on and how it's causing a lot of market volatility. And as part of this discussion, we're doing a little time travel back to the last time that we had a government shutdown, end of 2018, December to January. It lasted about 35 days. Dave, you mentioned that this time it seems a little bit different than what was going on for a lot of different reasons.
Well, there are different factors. The government shutdown is the same. The Democrats and Republicans can't agree with each other.
That never changes, right?
That never changes, right? And, it's all about where we should spend our money before we approve the budget. And of course, politicians always like to tuck certain, pet expenses into a bill, and the other side, gets, their fur gets up in the back of their neck, as you would say, and then all of a sudden, they don't want to approve it. So, unfortunately, it's a necessary evil that does happen sometimes. My advice this time is going to be the same as my advice last time. This is a temporary thing. You shouldn't make any major investment changes because of this. The reality is that, look, we're still the United States of America. We're still an economic superpower. And we're not the only government that's going through this right now. There are European governments that are going through the same type of thing, with various factions struggling to get the budget approved. And it's good. It's why we have different parties in the political system. We have checks and balances through three branches of the government, right? Because it's not up for one person to make that decision. But, if you're set the way you should be, if you're allocated the way you should be with your money, and you feel like, gosh, given my goals, my distance from retirement, I've got the right balance of stocks and bonds and other instruments, then you shouldn't be making any major changes. But if you feel like, okay, I've been too aggressive, then maybe it's different. Maybe you should make some changes. But it's not because of this. This is really just the impetus. And again, it's not so much about the government shutdown. That's one of three factors going on right now, right? You have the trade war, which is, starting to look like it was calming down and now kind of got all spooled up again. But you also have the technology, and everybody's wondering, okay, when is the music going to stop with this incredible technology stock growth? And when is someone going to be stuck without a chair? And see, the problem is the big investors will usually react quicker, like in the game of musical chairs when you're a kid, and they're going to find the chair. And it's sometimes a little guy that gets stuck without a chair, gets stuck standing.
Dave, back when the government shutdown happened in 2018, early 2019, what were clients coming to you about? What were some of their concerns that they had? Or were they worried? Did they feel maybe like it was okay during the whole shutdown because of the way that you were managing their money?
Well, I think they were concerned back then because it hadn't happened in a while. Now that it's happened essentially 7 years ago, I think people have said, okay, we've seen this movie play out. It's not a big deal. So they're a little more numb to it now. So it's not a problem. But yes, in many cases, because we had people heavily in bonds and bond-like instruments who were retired or approaching retirement, we had a more conservative position, they really weren't that worried about it.
Good.
Which is good.
Okay. Yes, and that's what you mentioned, allocation, right? Once you're allocated the right way, you don't have to worry as much. You don't have to adjust your strategy as much because you know that you have the perfect amount of stocks and bonds for you, for your goals and for your needs in retirement.
That's right. And that's exactly what we need to be talking about coming up here on the show is, how do you know if you're at the right place, if you're allocated the right way for your lifestyle, for your point in life, or whether or not you should be making a change? I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about your income.
You're listening to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we are talking about the ongoing government shutdown and what it can mean for your retirement and ways it might be affecting your retirement. And a few minutes ago, we were talking a little bit about the last time this happened, how it was a different situation than what's going on now. And we're seeing a lot more market volatility now, and partly that's because of what's going on in the tech segment. A lot of people have concerns that there could be a tech bubble burst, maybe similar but different from what happened in 1999 and 2000.
Yeah, and what makes it different, I will say, even if there is a tech bubble that ultimately does burst, is that a lot of the big companies now, these Magnificent Seven companies, are actually profitable. They're making money. Back in 1999, a lot of them weren't. When you have a price to earnings ratio and there's zero earnings in the bottom of a fraction, well, you have an infinite price to earnings ratio, and that just didn't make any sense. Yeah. And there are some times when companies don't make money and they have valuation, sure, but this was all across the board back in 1999. Today, a lot of these big companies, think about NVIDIA, right? Yeah. NVIDIA is a very profitable company, right? They're doing great. So are they selling at a higher multiple than, is most people would think is reasonable? Sure. But it's because of the future growth prospects, right? So even if there is a bubble that bursts, it wouldn't be as severe, I don't believe, as what we saw in 99. Because in 99, the bubble burst beginning of 2000, it took till 2017, 2018 for some of those tech stocks to come back. So it literally took 17, 18 years for that sector to recover. Yeah. That's a long time.
Yeah. So Dave, being heavily invested or too heavily invested in a certain sector like tech could be an example of taking too much risk. But what are some of the other ways that our listeners could maybe be taking too much risk and they don't even realize it?
Right. So an extreme example is what you just said, right? Having too much money in one sector and not being balanced. And how do you know if you have too much money in one sector? Well, you could look at the S&P 500, for example, and which is heavily technology laden, because the way the S&P 500 is you have 500 companies, but it's not that each company has 1/500th impact on the index. It's based upon the net worth of the overall company. And these tech companies are big. So when you start looking at NVIDIA, and you start looking at Amazon, and you start looking at Apple, those are some of the biggest companies in our country. So they have a high percentage weighting and effect on that index. But still, if you go to the S&P 500 and say what percentage of that index is technology, now wait a minute, if I'm higher than that, I'm definitely too high. And frankly, if I'm close to retirement, meaning within 10 years, and I even have the same percentage, then I'm probably too high. So that's one example and one way to fix that if you have too much in one sector. But the other one might be if I just have too much money in, let's say, growth stocks, right? There are two general classes of stocks. There are growth stocks and there are value stocks. Growth stocks are stocks that tend to be more overvalued, but they have momentum, like the technology industry. But there's other sectors that have that at various times, right? And the whole strategy with growth is you buy a stock, you ride the momentum upward, and when it stops, you sell it. The other type, value stocks, are more undervalued. Okay, this is where it's a more conservative play. They're more undervalued by the market, and for various reasons, which are probably beyond our show today, Sarah. But with this undervaluation, it gives them more downside protection. They're a little more conservative. Also, these value stocks typically have higher dividends, which means if you're retired or within 10 years of retirement, you should have higher dividend stocks, or at least start integrating those in your portfolio. So the first way of being too aggressive is having too much money in one sector of the stock market. The second one is having too many growth stocks compared to value stocks. The third is just having too much money in the stock market overall, because even if you're all value stocks that have high dividends, the stock market is still riskier than the bond market. So you want to have a healthy balance. And of course, as the general rule goes, if you're 20 years away from retirement, you're probably all stocks, right? But as you start to get within 10 years, you want to start to integrate some bonds in the portfolio, so that by the time you retire, you might be as much as 2/3 bonds. So again, if you're not there, then that's a third way that you could be taking too much risk.
Yep. And if you're at or nearing retirement and you're worried that you may be taking too much risk in your current portfolio, I encourage you to call our income specialist. You can call the phone number 833-RIS Radio. Again, that's 833-747-7234. And we will help you find a local income specialist right in your area to help make sure that you are not allocated in too risky of a way for where you are in your retirement. You're listening to the Retirement Income Source, where it is all about your income. I'm Sarah Samuels here with David Scranton, and we're talking about the government shutdown, what's going on now in the markets, what happened in the past, the last time we had a government shutdown. And Dave, you were talking a little bit about the stock market, the difference between growth stocks, value stocks, but really as you get within 10 years of retirement, people need to be moving out of the stock market. They need to be incorporating bonds into their portfolios.
Yeah, not completely, but just gradually. It's more like a rheostat where you adjust the lighting, not a switch where it's on or off. So, because the idea is you're gradually decreasing your risk. And the reason for that is because, if you wait till retirement to make this transition, then you want two things to be true. Number one, you want growth instruments like the market to be really high the day you retire. And you also want interest rates to be high. So when you transition quickly to interest-bearing investments so you can retire, you have to have two things that are working in your favor. Well, if you have a coin and you want to flip it twice and you want to get heads both times, there's only a 25% chance that's going to happen. So if you wait till the last minute, there's really a 25% chance both those things are going to be working in your favor, which means you might have to retire with less income or postpone retirement. So by making a gradual transition throughout the 10 years leading up to retirement, it's kind of like dollar cost averaging. You're putting money in periodically. So you're putting some money in when things are really high, when they're really low, and on average, it puts you in a good position.
Yep. That's where that 10 years out from retirement comes from. You feel like 10 years out that gives you enough time to make that slow, gradual change before you retire. It's
a good rule of thumb. And in the past, I've said 13 because, the market, I said the tech bubble, when it burst in or beginning of the century, it took us 17 or 18 years for tech stocks to come back. Well, the overall stock market, the S&P 500, took 13 years to come back, right? Yeah. But 10 is a good rule of thumb. It's a good rule of thumb. And
David, I've talked to a lot of our advisors, our retirement income source specialists around the country, and they've told me that most of the time, most people that come into their office that they're not working with yet, they are pretty much always too risky. Do you feel like that was your experience too, that people come in and they're just usually allocated too risky for where they are in life?
Well, they are. In the entire industry has a cancer in a way that, the industry charges fees based upon people's balances, right? And over the long run, the more aggressive stuff that they put somebody in, the bigger the balance is going to get, the more fees the advisor gets, the more fees their firm gets, and everything. So because a lot of these firms want to be more profitable, and if they're publicly traded, the fiduciary duty of a CEO of any publicly traded company is to maximize profits for shareholders. So if that means keeping clients more growth oriented longer so that they can increase their assets under management and increase their fees and their bottom line, well, then that's what they have to do. So it's a conflict between what's best for the industry and for the shareholders versus what's best for the people who are approaching retirement. And that's never going to get solved. Just like, the Republicans and Democrats are never going to readily agree on how the budget should look, right? It's the same thing here, is that there's always going to be that conflict between what's best for the firm and its profitability and the stockholders in the firm versus those investors of the firm that are approaching retirement.
Yeah. Well, I want to help answer some of the questions that I know our listeners have. We've had a lot of people write in. We've had people call the Ask Dave hotline. So we are going to be answering some of your retirement questions. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about your income. Thank you for spending some time here with us this weekend on the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton. And we've been talking about the government shutdown, what it could mean for your retirement, and what happened in the past when we've had government shutdowns previously. And now we're going to get to some of our Ask Dave questions. These are questions from people that have written in, whether they've left a comment on our website, incomeradio.com, with their question, or called into our hotline and left us a voicemail or talked to one of our people there with their question.
Oh, so we have multiple channels.
We have multiple ways to get in touch with the show. If you have a question
I'm not
your
safe
retirement.
anywhere, am I?
No, you got questions coming at you every way, Dave. So our first question here comes from Maria. She's in Cheshire, Connecticut. Maria says, my husband works for the federal government and he's been working without pay. We're planning to retire in 5 years, but this whole thing has been stressing us out. What's your best advice?
Wow, Maria. First of all, my condolences go out to you guys. We in the financial industry always talk about how it affects, the stock market and everything else. And but you forget that sometimes that there's real humans like your husband that are there that are, working for free. And that's not a lot of fun. But kudos to him for going to work every day in spite of this. From what I understand last time, and you would know better than me, most people, when we did get the budget finally approved through Congress and signed, that they went ahead and everyone got back pay, or most of the government employees got back pay. So we cross our fingers. Let's hope that happens this time so that your husband is not literally working for free. He just has a delay in getting that compensation. And, the real preparation, which hopefully you've done in advance, is preparing, because whether you're a government employee that has, goes through this unfortunate situation, or whether you're even working for a private company and you get furloughed, right? You get laid off, something happens. You always have to be in a financial situation that prepares you for this. So step one is making sure your expenses are reasonable. You're not spending all your income. The closer you can get to being able to pay your bills off unemployment insurance, the better off you are, for example. So that's one thing. And, keeping your fixed payments down, not going into a lot of debt, everything you could do on that front. The next thing, though, is having emergency funds. Today, with the markets doing well, it seems like there's this move toward, everyone should have 3 months worth of expenses in an emergency fund, whereas it used to be 6 to 12. And maybe I'm a little old school, Maria, but I still think 6 to 12 is a better number, because you just don't know what's going to happen, and having a little more cash makes sense. Now, when cash was paying literally zero, just a few years ago, that's a little tougher. But now that you can get 3 to 4% in a money market, if you look, I would say more like 6 to 12 months. Have more cash, have more financial flexibility. And I know that it's unfortunate when the market's going up double digits for you to have money sitting there at 3.5%. I get that. But, I think of it this way. It's like a bunt in baseball. When somebody bunts, they expect to get thrown out at first base. But why do you do that? Why is it called a sacrifice bunt? Because you want to improve the team, right? So the runner that's on base gets to advance. And the same thing is true here. But in the financial world, it's even better than that, because having cash also lets you take advantage of market volatility. So when markets take a significant dump, if you have cash, excess of cash, now you can put some in and buy low and take advantage of that. You could be a bit more speculative. So those are some of the best things that I would advise. At this stage, Maria, you have what you have in emergency funds. Your expenses are your expenses. Just do everything you can to get ahead of it, so that if this were to last 2 or 3 months, that you feel like you're in a good position, that you could pay your bills on time and still have good credit. And then hope that when all this is done, that your husband gets that back pay that he deserves. So, Maria, I hope that helps.
Maria, thank you so much for sending your question in via our website, incomeradio.com. And if you have a question for the show for our Ask Dave segment, you too can submit it through the website. That's incomeradio.com. Our next question comes from Frank out in Farmington, Connecticut. Frank says, my wife and I are pretty risk tolerant. We have a very high risk portfolio and we're both still working. Our retirement accounts are overfunded, so we feel okay, but are we missing anything?
All right, Frank, I can only give you a generic answer, obviously, because I don't have specifics about your situation in terms of how far you are from retirement and how overfunded you are. But, the rule is this, okay? If You can retire today. Let's say you're within 10 years of retirement, and you can retire today off of any pension that you might have if you have a traditional pension. I know high probability you don't, but you might. Social Security, and the interest and dividends off your investments. If you can retire today on that, then you're fine. You can take as much risk as you want, okay? If you can't, then you've got to say, okay, what if I'm unlucky, right? Like I said earlier in the show, that if you're going to make the transition last minute to an income strategy, then you've got to have two things true right before you retire. The markets have to be high, and interest rates also has to be high. And sheer randomness says there's only a 25% chance of both those things being true. So now I've got to say, okay, if the market's down 20%, and when I retire, and I sell a chunk of those investments and move to something that pays, let's say, 4% interest, will I be able to retire? If it's down 30%, will I be able to retire by doing the same? If it's down 40%, will I be able to sell a chunk of those investments, move them to something giving 4% interest, and retire? And that's where you say, okay, where's my pain point? How much of a drop can I take in the market if I wait too long and I get stuck with the market being down when I want to retire? And will I still be enough? In other words, are you 20% over, 30% over, or 40% over what you need? And then you can determine if you're comfortable with that. You might say, well, yeah, I can only stand a 20% drop before retirement. But if it's more than that, I'll just work longer and I don't mind. Okay, well, then that's your choice. But if you don't want to work longer and a major drop, and what's a major drop? Well, hey, at the beginning of the century, we had two 50% drops in the market. So if it happened once, it tells you it can, yes, happen again. So as a result, you've got to always think that if you really don't want to work longer, if I have a 50% drop, will I still be able to retire? And if the answer is no, then you might want to consider de-risking. If the answer is yes, then maybe you're right. Maybe you're in a good spot where you are if you emotionally have a high risk tolerance. So, all right, Frank from Farmington, hope that helps.
And Frank, if you are looking for an income specialist as you get closer to retirement, if you're looking to de-risk in your portfolio and make sure that you have the right retirement strategy set up for you, I would recommend that you call our retirement hotline. That phone number is 833-RIS-RADIO. Again, that's 833-747-7234. And really, that's open for anyone that's listening to the show that needs to talk to an income specialist, that wants to find someone in their area, even if it's just to do a quick check for risk in your portfolio and make sure that you're allocated the right way. Because, Dave, we mentioned a few minutes ago, but a lot of people are a little bit riskier. They're allocated in a riskier way than they really want to be heading into retirement.
No, we see that all the time for the reasons I mentioned. And the reality is that, you shouldn't be making a change because of the government shutdown. Or even the trade issues, I would say you shouldn't be making a change for that. It's about where you are relative to your goals. Now, I would encourage making a change if you're heavily tech laden. That's different because that could be if a bubble were to burst at some point, and I'm not even saying it's going to, and that could affect your ability to retire for a decade and a half in the future. That's the one thing that's going on extraneously that would I'd say force my hand. But beside that, it's all about your goals and your situation in life and what you want to accomplish.
Yep. And here on the Retirement Income Source, it's all about your income. So thank you so much for listening to this episode.
And we hope that you're back with us next week, same time, same station. I'm David Scranton here with Sarah Samuels. And yes, you're listening to the Retirement Income Source. And it is all about your income.